Greetings, everybody, from, well, somewhat overcast, somewhat sunny Southern California today. Good to see you. We got Mark from snowy Wisconsin, Sid from Kansas, Daryl from Atlanta. We got everybody from all over the place. Good to see you all here. Hope you had a great weekend, did something fun. Today, we are going to talk about the financial crisis, part 3. And just because of all the stuff that happened over the weekend, I thought, let's get some clarity on it. I know that most of you probably been inundated on any news feed, whether you're on Fox, CNBC, Bloomberg, KTVU, whatever, it doesn't matter. It's all about this current crazy financial crisis going on right now. So I thought I would get to a viewer question. Actually, 3 questions came in specifically on financials, banking, and how bank runs work. As you may have seen on the news going into Saturday, there were people lining up at Silicon Valley Bank locations around the US waiting to get their money out when the bank market opened that morning. So I thought it was like, okay, this is really interesting because we haven't seen anything like this. Gee, I'll let you guys tell me. When was the last time we had a bank run in the US? Like a significant bank run? Well, I'll let you do that one. I'll go to John's question here. John asked me this. He says, can you talk about how a bank run, how a run on the bank works? So what I thought would be kind of cool to do is just do something a little bit different here. I have to explain a couple different topics to make sure we all understand exactly what happened. And I'm sure that most of you know what a bank run is, but some may not. Hey, Traders Army, good to see you, my friends. Got everybody joining us today. So let me real quickly talk about how this all set up, and then we'll dive into specifically what happened with Silicon Valley Bank, how they put themselves in this position. And here's what's really crazy. Silicon Valley Bank put themselves in a precarious financial position by buying one of the safest instruments that you can buy, government treasuries. Yes, right. And we're all told, go to flight to safety, the risk-free trade. Well, there's risk out there. So let's start things off with my picture here and what I need to do to explain what this long line of people hoping to get their money out. Yes, built by, this is all AI generated here. There you go, Mark. I'm still getting occasional money from Washington Mutual. That was the last big bank run. Last big bank run was 2008. You had Washington Mutual. Customers pulled out, I think it was about $16 billion in just a couple day window. And basically what happens is the bank just doesn't have the money because it's tied up in investments. I think the next day, Wachovia had like $10 billion worth of withdrawals. So you had Washington Mutual and Wachovia in 2009 shut down because what were they doing? They're lending out their money to other institutions so that they can get a greater rate of return and pay the deposit interest. So let me explain very briefly what a fractional reserve banking system is, because this is what not only allows the companies to lend out money, but in all honesty, you got to be really on camera for this one. If we did not have fractional reserve banking, we would not have anywhere near the economy that we do. We would not be the largest economy in the world. The reason we're the largest, most powerful economy in the world right now, that may be changing, is because money, capital. You're taking money and you're leveraging that to build more stuff, more infrastructure, more companies, more widgets, more factories. That's fractional reserve banking. But how does it work, right? If we were all with no leverage, no margin in any aspect of our lives, this would be a very different country. And don't get me wrong, I'm all for leverage, etc. But the current situation of fractional reserve banking is going to make a lot of people here's butt pucker when you hear exactly what's going on. And Brendan Wendell, by the way, you were wrong, my friend. He tried to correct me on social media. Ain't having it today, Big B. So here's a simple example. This is not David Warner. Let's go there. I need to explain fractional reserve banking because pretty much everybody here is a part of this. And here's how it goes. Bob's got $10,000. And he wants to deposit that in the bank, right? He's got the money. He's like, okay, I was told I got to save it. I deposit that in, you call it bank ABC, doesn't matter what bank it is. Now, the bank takes that money and is going to pay him 0.23%. I know a lot of you are going, 0.23%? Are you insane? No, the national average right now on this is 0.23%. Yes, I know you can go some places and get more, but the national average is 0.23% as of this morning when I built these slides. So they take his $10,000 deposit and they're going to give him $23 a year. $23 a year. That's like 2 Happy Meals if you're lucky. Remarkable that you just get almost nothing. So what does the bank do? Let's assume there's also this thing called a reserve requirement, which is typically imposed by the Federal Reserve. The Fed, because it monitors all the banks, will tell the banks, here's how much money you have to keep of your customer deposits just in case people want their money. The rest of it, you can lend out. And I remember years ago, it was 10%. I'm going to use the example of 5% just for these slides, just so you guys can understand it. So, guy deposits $10,000. The bank has to keep $500 of that deposit, right? And what are they going to do? They're going to take $9,500 of it and lend that money out to somebody else. That's fractional reserve banking. So the reality is, of that $10,000, only $500 really has to be held by the bank. So now the bank is sitting there paying you, or Bob, 0.23%. And let's say along comes, what did I make up? Mary here. And Mary says, I want to get a car loan. All right, well, we'll charge you 7% for that car loan. She's going to pay $600 roughly. I know this is not perfect interest, but I just did it on the annual side. Roughly $665 worth of interest for the year. Okay, fine. For her, that makes sense. So maybe she takes that $9,500 and she deposits that in the bank. And now you can see where this goes. It's like, it's not quite a Ponzi scheme. It's just leverage on top of leverage on top of leverage. Now the bank pays her interest on her $9,500 deposit. You can see now they keep $475 of her money, and they lend out another $9,025. So this process can be repeated over and over and over and over again till ultimately the deposits off that initial Bob deposit, they have to keep a total reserve requirements of $10,000, but could have lent out $200,000 worth of money. Okay, that right there should be a little bit concerning for everybody here. After all of these, like, this person borrowed and this person borrowed, it's still leveraged off of Bob's initial $10,000 deposit. So Mary, when she deposits that $9,500, it's not really hers, it's the remainder of Bob's money, and now you're leveraging on top of leveraging on top of leveraging. So it's a little odd the way it works. How do the banks do this, or why do they do this, and how do they make money? Well, ultimately, over the course of that lending cycle for that $10,000 that Bob deposited, you're looking at interest paid, 0.23%. It's going to be about $460. But they're also going to be making $14,000 in interest on that loan. So they've net positive $13,540 gain off of Bob's initial $10,000 deposit. So let me ask you this one. What would happen, and you guys, who's quick to type in chat, what would happen if 5 customers, in the scenario that I've painted, if 5 customers came in at the same time and said, I want $2,000 immediately, I want my money right now, what would I get? Right? What would happen in this situation to whatever bank this is? Les, let me real quickly go back here. I see you're coming at me with question marks. Sounds a little like a Ponzi scheme. Yeah, kind of, Liz. It's just got a prettier name, fractional reserve banking. Are things not obvious from the Australian point? Yeah, well, Les, I'm trying to find your comment here. What did you had questions? Why the spinning top on the ES? Okay, I will get to that one here. Big Ab Merlin, why is the brokerage firm like Schwab getting hammered so much? Seems like it might be a buy. Good one, Big Ab. I actually am long. I sold puts today on Schwab, and I'll explain that one here in a second. Merlin, my $10,000 is guaranteed by the FTC. Why should I care? Good point. So don't worry. Here, and it's a great point. In this example that I've got here, nothing would really happen because in theory, you can see up here, the total reserve requirement that the bank has been holding is $10,000. So there's no problem here, right? Those 5 customers come in, they get their $2,000 immediately, no big deal. And Mark is right here, they would get someone else's money. And this is what fungible here is. It doesn't matter, right? $2,000, you care if it's yours or anybody else's? I don't care, just give me my freaking money. All right, now here's where the situation changes. What happens if you had 40 customers came in at the same time and demand that $2,000 immediately? I want my money right now. This is what happened with Silicon Valley Bank. So you can see in this example, reserve requirements were $10,000. Well, if 40 customers came in requesting $2,000 each, that's $80,000, which means at this point, this bank is now underwater by $70,000 that they owe their customers. This is what's happened with Silicon Valley Bank. Customers were hearing that there might not be money there. They went, oh shit, I want my money. So they start pulling money out of Silicon Valley Bank. And this is what it doesn't have to be Silicon Valley Bank, but it's just a run on banks. So what the bank will do is a couple different things. Number one, they sell off the assets that they purchase with customer money. Or they can go out to another bank and ask for some money to cover the run, if it's a temporary thing, if they feel like it's a temporary thing. So with Silicon Valley Bank, 90% of their customers had over $250,000 worth of deposits. So this is not your mom and pop retail savings company. This is an institutional lending company that's funding many of these venture capital startups in Silicon Valley. So to Les's point, if I got $10,000, who cares, right? I'm insured. Exactly. If you're ever in that situation, you shouldn't have worried if you're a Silicon Valley Bank customer. If you're under 250, you should be made whole. Now, again, I say this with a little asterisk here. That assumes that you trust that the FDIC will, in fact, cover those deposits and the FDIC is, in fact, solvent. I don't know their balance sheet. I don't know where they're getting their money from. So if 90% of Silicon Valley Bank's customers have over $250,000, what was happening is a lot of them were pulling anything out above 250 because it's uninsured. So you heard Mark Cuban had between $8 and $10 million there. Roku, I believe, had $490 million sitting at Silicon Valley Bank. You know Silicon Valley Bank is lending a lot of that out. So Roku, stood to lose everything. I mean, I didn't look at the stock of Roku, but if this did not get bailed out by the government, and it is a bailout in my mind, we'll talk about that in a sec. If that didn't happen, then Roku might have taken a huge nosedive. I mean, you could have seen some stocks really plummet. So that's what a run on the bank is, and that's what fractional reserve banking is, just to kind of set up those two concepts. Now, if you look at the root cause of this, in the example I showed you, I used a reserve requirement of 5%. I remember back in the 90s, it was 10%. What's the reserve requirement today as of this exact second? And just in case Brandon Wendell shows up and tries to say that I'm wrong again, I will show you right here that I'm correct. Now, this was released November 29th of 2022 from the Reserve Board, announces annual indexing of reserve requirement exemptions for low reserve tranche for 2023. For those listening to the podcast, here it goes. The Federal Reserve Board on Tuesday announced technical details related to reserve requirements for depository institutions. The annual indexation and publications of these amounts are required by law and does not indicate a change in depository institutions' reserve requirements, which will remain at zero. That's zero. So in this situation that I have over here, with Bob depositing 10 grand, this ultimately could turn into infinite amounts. Just lending and lending and lending and lending and lending and lending. And this is, I guess, the real scary part. This is not in my mind, not a problem that Silicon Valley Bank is in. This is what the United States is in. This is a systemic problem that is predicated by the Federal Reserve by telling banks you don't have to hold customer deposits. Just for right now, I remember when this was enacted. It was in 2020. Right when the financial crisis hit, they cut it back to zero. And the reason for that is we need money out there lending. Let's get that money out there. Let's get it pushing. Let's grow the economy. We are in a panic mode because of COVID. And I understand that kind of makes sense. But if you get a run on the banks, this Monday morning, I was talking to some friends over the weekend, and it's like today could have been one of the ugliest financial crises that we've seen in a long time. If the government didn't come out and say, we'll guarantee all those deposits for Silicon Valley Bank and Signature Bank, you would have seen a meltdown today in the financial markets. And why? Because if you think about the impact of anybody over $250,000 didn't get their money's not insured. So anything is technically lost. Maybe they get something out of a bankruptcy procedure, who knows, but it's not insured. From that point, a lot of those companies that had money there were businesses, and that's payroll, right? They're using that to buy and grow their company. That's R&D money. And those costs all of a sudden would stunt the growth for any of those firms that had over $250,000 at Silicon Valley Bank. Unloaded on Schwab myself. Well, we'll talk about that in just a second because I'm actually looking at going long Schwab. I'm looking at going long Schwab, JP Morgan, Bank of America, and XLF, and XLF being the riskier one. So, first off, it's not just the reserve requirement issue, right? It's about the the regulatory stuff that changed in 2018. So when Trump took office, one of his big things was less regulations, less rules. And there were rules on banks that had between 20, is it 20 and 50? I want to say it was between, oh man, I forget the exact amount. I want to say it's between 50 and 250 billion. If you're between 50 and 250 billion, there were certain agencies that had oversight over your bank and were monitoring, making sure you were doing things the right way. Under Trump's administration, they actually removed some of that oversight. So now some of these watchdog agencies were no longer staying on top of what these mid-tier banks were doing. That's what they call them, between 50 and 250 billion. And because of that, there were some practices done by Silicon Valley Bank. I was reading some documentation showing that they're lending. They were almost going into substandard lending protocols, like not really going up to snuff with the requirements that you need to get loans and things like that. They were kind of, it's fine, we'll let you do that. They also were paying a little bit higher interest rate than some of the other banks. Remember, when a bank pays an interest rate to you, they have to be earning money on deposits that's greater than the interest that they pay you. So you may be asking yourself, well, why in the hell did Silicon Valley Bank crash so much? What risky investments did they make? This is where I find it extremely entertaining. I know it sounds masochistic, but I find this extremely entertaining because they tell you that one of the safest investments that you should be making, you buy bonds, right? You buy treasuries. They're issued by the government. They're safe. They're stable. You're not going to lose your money. Well, that's not necessarily true, right? They had been buying bonds for a couple of years now. And let's say they bought a 10-year bond in 2020. Well, let's go real quick and look and see what the yield on that bond was in 2020. And if I'm boring you guys today, I apologize. I like this stuff because it really is the mechanics of what caused all this, not just, Silicon Valley Bank is, in trouble. You got to understand how it all came to be. So let's go look at the 10-year bond real quick. I go up to the top here. Here's your 10-year, and let's just put it on a daily and go back to 2020. So they were buying 10-year bonds back, let's say 2020, just to play it safe. Well, the 10-year bond was paying 0.5%. So they may have bought with some of that money these 10-year bonds. And maybe they bought some at 10, maybe or at 0.5%, maybe they bought some at 1%, maybe they bought some here at 1.7%. And the point was that they're trying to be safe with their money, right? You have $220 billion worth of assets. You got to put some in some safe places, and bonds are safe, right? Oh, put your money in bonds, they're safe. Really? Well, you would think that, that your par value, your face value, if you hold it all the way to expiration, will probably be safe. Yeah. But if you bought a bond that's paying you 1%, and as of today it's paying 3.5%, nobody wants your bond at 1%. In order for you to liquidate that bond, you can't sell it at the $1,000 par value. Now you have to drop the price of your bond. And you're like, wait a minute, why do I have to sell my bond for less? Because people right now can buy a $1,000 par value bond and get 3.5%. And you're going to try to sell me your $1,000 par value bond and I make 1%? That's the dumbest investment ever. Why would I buy a 1% when I can get the exact same par value and get 3.5? So what happened is, in order to cover some of these deposits at SVB, they started selling their bonds. But they had to sell them at a huge discount and lost hundreds of millions of dollars, and therefore now all of a sudden they're in a losing position and locking up their customer accounts. So if you look here, and I know you're looking at this yield of the bond, let's look at something like TLT, right? Now TLT is obviously the 20-year. We could look at some different bond products, but notice the value of TLT, right? If you go here from, let's say, July of 2020 to where we are right now, TLT is down 38%. What that means is, let's just assume that SVB had 20-year bonds. Well, if they were selling them to cover deposits, withdrawals, then SVB took a 38% hit on that investment, a safe investment, right? That's the problem here. Now, if they held to expiration, the bonds would be fine. However, they were forced to sell these investment products at a loss because customers are like, oh my God, I want my money now. I'm hearing there's troubles at SVB. I got it out now. And it created hysteria. Everybody freaked out and started doing not only a run on the bank. By the way, there's two different kinds. A run on the bank is technically where you physically go down to the bank, pound on the windows and say, give me my freaking money. There's a silent run on a bank, which is most likely what is happening here. A silent run is where you're just going to log into your account. You're going to start doing some wire transfers out of those accounts as quickly as possible. So that's the gist of it. I find it kind of fascinating, but in that 2018 deregulation bill, I think that's what really opened the doors to letting Silicon Valley Bank maybe do some things that were a little bit riskier. So if you have questions on that, let me know. That was, again, high level at fractional reserve banking, what a run on the bank is, and then giving you an idea of why Silicon Valley Bank put themselves in this situation. Now, I think the other part of this that ties directly into it is the regulators and government's assault on cryptocurrency and digital assets. They are absolutely going after it. So what they're doing now is they're attacking banks like Signature, what was a huge onboarder for the crypto world, and now they've shut down Signature Bank. So the crypto world feels like they just got locked in. Of course, Bitcoin's up 24% since Friday, so I'm okay with that. So it's conveniently tying in the removal of digital assets and crypto from the banking system with this kind of bailout. Very, very interesting stuff to me. Let's see. Rob says bank printing money by leading without any money to back it up. Yep. And by the way, just so you know, you may have heard President Biden say that this will not come from taxpayers. You and I will not be bailing these people out. And I don't believe that the money is going to come from where they say it's going to come from. Basically, they say they have a $100 billion fund that has been paid into by banks over the years. So part of bank memberships and fees to the Fed, this goes into this big fund that has about $100 billion in it. Personally, I'm calling BS. I just don't see that happening. However, that's what they're telling us. And there's also another $25 billion that's part of the Treasury Exchange Stabilization Fund. So you got about $125 billion to help balance these things out. So yeah, I agree, RJD. Big fat lie. Yeah. You know, at this point, they have to calm our fears and make everybody feel calm. Because if they don't, can you guys imagine this? I apologize, I've been cursing too much lately, but can you imagine the shit show that would have happened if they did not announce Sunday night that they were going to bail out and honor those deposits, right? So you got $50 million, you're Roku, and you got $400 million sitting at Silicon Valley Bank. Your business might be done come Monday morning. But the fact they bailed you out made you feel comfortable, and depositors like you and me feeling comfortable as well. So while I think it's a good thing, I think that we need to look at the way banks are structured, what they can do, because this is a systemic risk. This was a massive systemic risk that almost imploded. And if Silicon Valley Bank went down, I'm sure a lot of you guys here were thinking the same thing over the weekend. Be honest. How many of you were thinking, just type yes or no, how many of you were thinking this weekend, shit, I'm going to my bank, I got to get my money out. I'm getting my money out of my bank. How many of you thought that this weekend because of the fear that was spreading like wildfire? I was listening to some group, how do we call them, meetup things on Twitter with like prominent A-listers in the finance world. And it was like, they were spreading fear so bad. I was like, man, you're really, really freaking out. So nobody here? Might have been the best day for buying some stocks. I agree, RJD. I think it's a pretty good day, although we're not out of the woods yet, right? I also was hearing that that customers of Silicon Valley Bank who were told they had access to all their money today still don't have access. So I'm a little bit, I guess, pessimistic on that one. We'll see. So RJD, you thought about pulling money out? I think it's just a natural thing when you hear it, right? Like, oh, run on banks are shutting down. You know, you instinctively get caught up in the hype. I will tell you that you have nothing to fear. If you have under $250,000 in a bank, don't worry. Don't sweat it. Just don't even keep yourself up at night. Now, if I was a hedge fund or a VC company or a startup and I had $100 million sitting over at Silicon Valley, totally different ballgame. I might have freaked out a little bit here. Good. I made a deposit. Good for you, Noam. Good. Yeah, don't get caught up in the hype. But I had some friends who were freaking out. I had friends like, I'm going to pull my money out. I'm like, why? You don't have over 250 grand. You're fine. Everything will be fine. Maybe safer in Canada. I think Canada actually had a run on the bank more recently than the U.S. did. I think they had one in 2016 or 17. These things happen all over the world, the run on the banks. The lesson learned, at least for me, would be if you are somebody who has a lot of wealth, let's say you've got a couple $1 million, do not put it in one account. what happens is a bank will entice you to put your money into their account and keep it there, and they'll give you extra perks. Oh, if you keep your $2 million here, we'll give you this, this, and this. Look, I personally would never, ever keep over $250,000 in any one bank at any one account. Spread it around. Move it around. You know, you don't know what can happen in the financial system, but if you do have FDIC insurance on those accounts, you're good to $250,000 per account. Spread it around, no big deal. Now, if you got $400 million, you're going to have a hard time trying to find out where that goes. You know, one thing that may, I guess, be a part of opening an account in the future will be transparency on the part of banks and how much they're lending out. What are they doing with their funds? Right? It would be good to know. Because I'll be honest, I would have actually thought that Silicon Valley Bank would have been safe. Why? Because you're buying government treasuries. So who killed Silicon Valley Bank? Federal Reserve. By jacking rates up 4.5% in the last 12 months, the yields on these things have shot up, and all of a sudden, Silicon Valley Bank thought they were being safe, and now they got hosed. So, yeah, every country's got them, RJ. No money, more problem. Yep. So, you know, for part of this, one thing I like about it is I actually like, you know, the cryptocurrency digital asset side. Bitcoin prevents this type of problem. You don't get a run on the bank for Bitcoin because you can't make more. There's only what there is. So it's not like, you want to sell your Bitcoin, sell it. It's there. And be your own bank. Don't keep it on an exchange or any of these things. Anyway, had to throw that one out there. Let me see. I had a couple questions that came through. What's your take on the bailout? I think I already covered that from Gene. My take on the bailout is technically they're not calling it a bailout, right? I know I've been reading and hearing from some people that they feel that the CEO of Silicon Valley Bank should go to prison, blah, blah, blah. I disagree. I don't think he should. They made some bad investments. I don't think they did anything criminal. I don't think there's any malintent there whatsoever. They got caught by this Fed action. And, you know, a lot of people don't think that these actions by the Fed really create any harm. I disagree. You know, we talked about the lag effect. Remember, we talked about when you make a rate increase, it takes between 9 and 12 months for a rate increase to hit the bottom line. Well, we've had 4.5% increase in 12 months, which means some of them are just starting to hit the bottom line. And this is one of those casualties because they thought they were being safe. It's really kind of sad. My thoughts on them bailing them out. I think it sets a double standard, and I don't like that they did. I like it because the markets didn't implode, which of course as a trader, let the markets implode, right? I'll hopefully buy at a cheaper price. But as an American, as someone who wants stability for our country and growth, if they did not bail out and do this bailout, I think we'd be in a very, very bad place for quite some time. Yep. And it's funny, Kev, somebody on Friday's show was saying, what about First Republic Bank? They look great. I'm like, it's a regional, smaller bank. I don't feel comfortable with them. You know, you notice the ones I said that I'm looking to buy. I sold puts on JP Morgan. Why? Because I'm buying JP Morgan. I sold puts on Bank of America, even though I hate Bank of America. I'm okay owning them because I don't think that they're in this situation. I also today bring up Schwab. Schwab got wrapped up in this, and Schwab issued a statement today saying, "Hey, our books are fine. We have no exposure to Silicon Valley Bank." So I sold the 51s today. So I'm right. I think at 50 or 51. I think I'm the 50s actually. So I sold the 50s expiring Friday and got about 1.5% for the week. Okay, I'll take a 1.5% for the week based off people freaking out on Charles Schwab. RJD said it correctly. It's the regionals, it's the R2s, it's the smaller ones that are the ones that are more likely going to face some problems. Yeah. How about banks that have big bond assets? Good question, Afrida. I don't know. There's a lot of variables that go on in this scenario, but and now you have to immediately start thinking about anybody who has big exposure to bonds, right? If someone's been buying bonds as an investment vehicle to generate interest and keep money, quote unquote, safe, if they keep it to maturity, there's no problem, right? So if they bought a 10-year bond in 2020 and they held that all the way through to 2030, no problem. Right? The only problem was you locked in at the 2020 interest rate, which is like 0.5%. Okay, you're not doing well with that, but at least you wouldn't lose value on selling that bond. Here, Silicon Valley was actually forced to liquidate some of their bond holdings, and that's what forced them to take losses. Merlin missed it, but what was the actual cause of this bank fail? Okay, interest rates have risen, but When did this hit? So the reason, JD, is that they had treasuries. They had a whole bunch of government treasuries, which they tell you is the safe place to go. But as interest rates rose, the price of those bonds plummeted. And we had a chart up here that showed about 38%. And basically what happened is they didn't have enough money to pay deposits. They keep selling stuff at a loss. They lost a ton of money. And let's not paint the picture that Silicon Valley Bank is bankrupt. That is not the case. It's just they ran into a shortfall in capital and had some major problems. There is money there. There's tons of money. This isn't like Terra Luna, which was, a total Ponzi scheme. This isn't Sam Bankman-Fried, which is a fraud. This is a very legitimate bank that got caught with bad investments and then a bank run at the same time, forcing them to sell those bad investments for a loss. And all of a sudden, they incurred big losses and the money's not there. So weekend, everything changed. No limit. Yeah, and RJD says weekend changed everything. No limit to FDIC insurance. This is what I don't like about it. And I mentioned double standard. So I go into a bank with comfort knowing that $250,000 is insured. Anything over that, I'm taking on risk. What the government and the FDIC, so it's basically the Federal Reserve, the Treasury, the FDIC, and the president have all said, we're going to honor all those deposits. Look, that's a risk of playing the game. Personally, I think that's part of the risk. So basically somebody took a risk, they got burned, and because there is a systemic risk possibility here, and I do agree there's a big systemic risk, the government came in and said, okay, we'll honor all that. Well, wait a minute. What happens if I've got $100 million sitting in a bank account and that bank goes under? Are you going to save me too? Right? Why is it that you do this one and maybe not the next one, or haven't done them in the past? So I don't know. I don't like it. I think it's a double standard, but again, it's that double-edged sword. If you don't do it, we would have had a monster market meltdown today. And either way, I'm still happy owning the tier 1 banks longer term. All right, Chris, good to see you, my friend. After 2008 and the last few years in crypto, not scared of much. Yeah, well, crypto, I mean, it desensitizes you to everything. Yes, RJD says it will increase banking costs for all of us. Ultimately, most likely it will. Again, I don't know about this fund that these banks have, quote unquote, been paying into to the tune of $100 billion, that's where this bailout's coming from. Sounds a little bit fishy to me, but I don't know. I don't know, Pepe. What do you say, Traders Army? Theoretically, that could trigger a bond bubble if a lot of bond, yeah. Right, because, well, and again, if they, I think Traders Army, if they didn't do this, think what would happen to more banks that are holding bonds. And I don't know the balance sheets of all the banks out there. There's just way too much information in the financial world for me to know it all, so I apologize. But if you have a lot of banks that are holding bonds and they're thin on capital, meaning that their money is locked up in these things, there may be some other exposure here to other banks. I don't think we're done seeing the pain point yet for some other banks. But I think that the action on Sunday by the FDIC, Treasury, Fed, government, etc., kind of calmed the fears that they're going to let it melt down. Like they're pretty much like, we'll bail out a bank if it has an issue with this. So there you go. That's the overall. I beat the system, didn't break a sweat. That's always fun when you don't break a sweat doing that. Let's see. Liz says, I see the Silicon Valley Bank exec was, yeah, right. CFO, he was at Lehman Brothers. I don't know. Hey, Corey. Good to see you, my friend. I didn't know whether it's you or Chuck. Yeah, I did see the CFO formerly worked at Lehman Brothers, which I thought was kind of interesting. And, here's the other thing. People are freaking out and saying that they need to go after the executives of Silicon Valley Bank because they paid out a huge amount of bonuses just a couple days before they got shut down by the FDIC. Well, don't know enough there either. Maybe these are already existing bonuses that were to be paid. Personally, if that happened, I think there should be a clawback. I think that anybody who received a bonus, right, especially in the week before this happened, that should get clawed back right away, but it probably won't. You gotta love it. So, John says, do you see a big bounce when the smoke clears? I see a bounce in crypto, in banking stocks, predominantly because you have this rising rate environment. Historically, banks do better because they're lending out at higher rates. They do better in a rising rate environment. So that's why, I looked at JP Morgan yesterday, which would be my number one pick for my portfolio. Today, nothing really changed. This was down 1.8%, but just kind of holding right there. I have Got to write down all my strikes. I have too many options positions open right now. But I sold puts expiring Friday on JP Morgan. Those presently are out of the money, which is fine. I'll just collect my nice premium on all these. Because of the fear, the premium was looking really good on almost every banking stock out there. Corey, you probably saw that today too. Some of the premium surges were huge, especially like you look at what was that? Is FBC? What was FRC? First Republic? Yeah, First Republic Bank. Take a First Republic today. Down 61%. I'm sure that if you were looking at the option chain for First Republic, the premium was just off the charts. Like just crazy. Well, that was a monster decline. And you got to ask yourself, is First Republic safe? Like, is it worth jumping on First Republic, which right now is down 75% in 5 trading sessions? Well, I don't know First Republic. I don't know their business, and so I'm not going to just buy or sell puts on this or buy the equity because I feel like it's safe, right? I'm not going to do that. But like I looked at Charles Schwab. I know Charles Schwab's business. I know where they make their money. They're not doing startup loans, right? They're in a much better situation. There was no exposure to Silvergate. Could I be missing something on their balance sheet? Sure. But if you look at how much they've fallen in just the past couple weeks, Schwab right now is down about 31% as of where they close. I feel like I'm okay with that. So I thought, great name, by the way. I thought that this one is probably going to be okay. And if I get exercised, I'm going to be fine with that. I'll hold it. And I do expect there to be a bounce back up here once the realization that those deposits will be covered. And then there's Bank of America, which is the least favorite of the bunch, but I did have the 28 calls on that one. I'm not sure. I have to write them down for tomorrow's show so you guys know my strike prices. When you add on to crypto after tomorrow or DCA? Right now, Alexa, I'm not adding anything to my crypto. I have my portfolio of crypto is pretty substantial. The only one I'm doing is I do weekly purchases of Bitcoin, recurring payments, so I don't even care what happens to Bitcoin. Just I'm going to buy it every week. I actually set that up for the CIL class, but I'm going to increase that amount just drip, constantly be buying Bitcoin. So there you go. Let's see. Problem is that many of these stocks will get repriced now. I agree. I think so. And that goes to the final question here from Woody. Would you buy financials now? Look, I'm not a financial advisor. I can't tell you guys what to buy, but I do think that there's a lot of value out there. There's some really good value plays. And I don't like that Bank of America broke below these lows that we saw in October. Broke below that 29, call it 30 mark. Well, there is an unfilled gap here that I'm not comfortable with at $25 on Bank of America. But XLF, for example, if you're nervous about it, XLF is going to give you maybe a bit more exposure, right? More exposure than you might want to those tier 2 banks, which is kind of where the problem is at. But you're still going to get some pretty nice premium here. If you look at that trend on it, XLF has got a pretty nice decline from that peak we saw just about a week ago to where we are today. Down 13% for an ETF that's got dozens of financial firms. I think not a bad shot. Did you buy also Wells Fargo since you bought? No, I didn't buy Wells Fargo. I could have. Let's look at WFC. Yeah, this looks just like the Bank of America chart. It's funny, you're giving back like almost going on almost a year worth of gains in just the last 3 weeks just because of what's going on. So I do think there's opportunity out there. Just be selective, and it depends on what your strategy is. I'll show you right here the bottom. This is the XLF components, which I think there were 67 components. You have First Republic down 61%. You have this is halted, so this one's not even open for trading. This is done. This is Silver Bank, Silicon Valley Bank down 60%. But you have a bunch of other ones here. Zion, Huntington Bank Shares is another one people are kind of focusing on, thinking they may be in trouble. You got Signature. So you got quite a few that are just really, really beaten up here. But then you look at the other end, there are some that are doing rather well. Of course, this is an exchange. CBOE, CME, ICE, those are all exchanges, not necessarily banks. But if I scroll down here, JP Morgan down 1.8. Again, go with the bigger ones. Let's see. Hey, now I'm new. No, I did not buy FRC. Absolutely not. While I look at the price chart and I go, man, it's down 75%. It doesn't mean I need to buy it because that may end up going all the way to zero. I just don't know. So if I was going to buy FRC, First Republic Bank, I need to do some research in the fundamentals and see just real quickly see what they're doing, where's their exposure at. But I'm pretty sure that Wells Fargo, JP Morgan, Schwab are not in the same business. They're completely different type of financial institutions than Silicon Valley Bank or Signature. Marlon, how do you think VC companies in general will fare? They got hammered today, but this is even a nightmare for them. I think that it's a wake-up call, I think, for a lot of the financial world. And I think anybody who's dealing with VCs understands the challenge. When Silicon Valley Bank went under, what's going to happen to the whole Bay Area? What's going to happen to that Silicon Valley area? If there isn't another on-ramp for small tech companies to get started and get capital, which Silicon Valley Bank was kind of like, it's it. I mean, it's Silicon Valley powered by this bank. If it doesn't find a replacement for that, then what does that do for growth in the Bay Area, right? And just think of all the side effects of that. If there's no more money going into Silicon Valley, or at least not at the rate it was, because Silicon Valley Bank was actually doing loans maybe they shouldn't have been. If that money's not going in there, then startups don't go there. If startups don't go there, then real estate prices start to fall. If real estate prices start to fall, there's less consumption for businesses and residents and gas stations, and all of a sudden they start doing layoffs. And see what I'm saying here? There is that potential that, let's revisit this in 6 months or a year and see what damage this might be. It's strange to think that a bank could have that big of an impact on an economy, a whole geographical area of the country, but it might. It may actually have a big impact. So right now, if you're a startup, where are you going to go get money? Where are you going to get your money? I think what's going to happen is, let's say I'm starting, widgets.com, a new tech company. And at widgets.com, I was going to use Silicon Valley Bank. Now that's dead. Now I'm going to go look for other suitors. Do I go to Wells Fargo? Do I go to Bank of America? I have a feeling that those banks are not going to be as favorable because that's not their area of expertise, right? Their area of expertise is not going into startups. And maybe they start building out branches in those different areas. I don't know. It's all speculation on my part at this point, but I do think it's going to cause some longer-term damage if they don't get a replacement. Because where do VCs getting their money from? Not only were they getting it, but where they parking it, right? Could be a big problem going forward. All right, let's see. So I did that one. I got through my questions. And what time is it? Wow. We did a whole show on that. I didn't even go through the markets. Let's real quickly run through, because I had a good day today. I'm sure some of you had some pretty good days as well. My silver position looking great. So is a little natural gas pop as well. I'm going to start things off at the bottom and work my way to the top. Crude oil. No big shocker here. Sideways action. 2.45% slide. Now it did get a little bit near the lower end of its range, but still just sideways range-bound market for crude oil, so no big deal. Russell 2000, 1.56%, continuing its fifth day in a row of bloodletting. I actually expect to see a bounce on the Russell tomorrow, just simply because the low we saw back in December of last year, we kind of have a bottoming tail right into those lows. It would not surprise me to see a little bit of a bounce tomorrow on the Russell 2000, just kind of a sympathy bounce, especially when you look at what the percentage from peak to trough here. That's 11.3% slide in 5 days. That's pretty darn good. Moving up the ladder, 0.34% for the Dow, which of course broke down below that yellow box a while ago. It's also sitting in a demand zone right around 32,000. We're at 32,555 presently, and you can see that demand zone going back into November of last year. Again, you have the Russell sitting near a demand zone, the Dow sitting near a demand zone. How about the S&P? Well, we tailed into not the best demand zone. This big kind of a cluster over here, but similar picture. Pretty big slide coming off that shooting star we talked about on that Monday morning. Like the next day, it looks like a great shooting star, and boom! Shout out to Gabe. I know he was talking about loading the boat on that shooting star, so good for you, Gabe. I hope you're still holding that short position, but expect there to be a little bit of a relief rally here in the next couple of days. NASDAQ was your third place finisher, which had a long-legged doji. For those of you who don't know what that is, a long-legged doji is not a nickname for Gisele Bundchen. It is actually a candle formation that's a long topping tail, a long bottoming tail, and opens and close right around the same price. So ultimately, it was a 0.72% gain for the NASDAQ, but a lot of indecision. There was just so much concern and fear today in that market. Made some good intraday opportunities. All right, almost at the top. Gold. Now, I love this. I love the gold broke out of that upper range. We talked about it going and challenging that 1900. Now, the target's 2000, right? You're looking for that higher end range. I've got that little blue line drawn right at 2000, which takes us all the way back to some highs from April of 2022. Granted, 1960 will probably be a pretty tough point as well, but just a 2-day huge pop up here. You've also seen the bond markets plummet. If you look here, we looked at that 10-year. Let me show you again. Look at the drop in the 10-year over the past 3 sessions. I mean, that is monstrous decline in the yield. We went from 4% to 3.5% in 4 days. That's pretty significant, which of course has helped out our yield curve tremendously. There's your daily of the yield curve. This is the 10 and the 1, which looks fairly decent now. And here's your 10 and the 2, which moved up at 14% today. So pretty good. 5-minute chart. Sorry, I'm trying to get through all this real quick, and then I'll go through your questions here. Let me finish up. So I got that one done. What else do we have? We had the VIX, right? There was another one. So, you know, our VIX, we talked about when it broke above 20, people were like, oh, VIX is high. No, not really. Now today you actually saw it a bit higher. We got to 30. Again, I still think that the historical measure should be respected, which is over 40 is when you really should start looking for buying opportunities. So all in all, a high VIX up 6.9%. Dollar index dropped about 1% today as well, which I'm a little bit bummed about. I thought we were going to continue to see this move to the upside. Was targeting that 107 mark for the dollar index. All right, what other questions do I have? And then I'll get to the end of the day. Powell might get his opinion in the jobs market. We could see that. Again, tomorrow, yeah, I saw it come up in the chat from John. Yes, CPI is a big one tomorrow. Here is your economic calendar for tomorrow. That date is wrong. I'm not sure why that says the 10th. Leave it to me to not do my job and put the numbers on the screen correctly. How about that? It's just such a great show. How about that? There you go. So here's what you got cooking for the 13th. Starting things off in the UK, it's going to be in the wee hours of the morning, so just after midnight tonight. You got claimant count change, their unemployment rate, which is expected to increase a little bit. You also have the Swiss franc coming out with producer price index. At 3 in the morning, it's an interesting time. Normally it's not that early, but for whatever reason, they're doing the NFIB Small Business Index coming out at 3 a.m. So for anybody who's watching that Russell, which has been pummeled lately, remember, Small Business Index is pretty much what the Russell 2000 is, so that could have an impact on it. Moving into the 5:30 market, which means 1 hour before our equity markets open, you can see there they've got consumer price index expected to decline from 0.5% to 0.4%, and also the year over year expected to go from 6.4% to 6%. Now, of course, that is what the Fed wants. They want to see that CPI number keep dropping. Ideally, they would like this number to be 2%. We've got a long way to go, but we were up over 9%, so I guess this is, a slow trajectory back down to where we were initially. And hopefully we'll get inflation under control, and then we can focus on the rates. Now, that said, I'm not going over an hour today. That said, let me real quickly look at the rates, because that has changed dramatically. Boy, based off the announcements from Silicon Valley Bank and what happened last night with the government, here is your probability chart. You remember yesterday, or 2 days ago, not 2 days, let's call it Wednesday of last week, there was a 79% chance of a 50 basis point increase. Today, not even close, right? Now there's a 67% chance of 25 basis point increase, and a 32% chance now that they're going to keep it right where it's at. I maintain my position of 25 basis point increase. I just think that would make sense, given that's the last rate was last increase was 25 basis points. But boy, it's been some real volatility and swings on expectations for what the Fed is going to do. A lot more people thinking, oh, you know what? They're not going to raise at all. They're going to keep it right where it's at, which I don't know. I think that they should be raising 25 basis points, but I don't do it. Let's see. Rob, look at the day charts for PACW. All right, let's do it. Look at these few for you, Rob, and then we're out of here. PACW, PACW. Oof. From $28 down to a low intraday today of $5. Does it look like the short sellers covered today? Well, one way you'd see that is with your climactic volume. So I don't know if it's necessarily just short covering or if it's just a lot of people jumping in and saying, hey, some of these banks are good values. There is no doubt in my mind that some of these banks are very good values, right? Just you can't have a bank that was $28 like 5 days ago and all of a sudden it's trading at $4 or $5 and go, still overvalued, right? You're going to find value investors. Judging by the volume here, I would say that PACW is probably bottomed out. Now, I don't know, but it just feels like it. This huge pain fall off the panic. Government steps in and says, hey, we'll honor all the deposits, and then all of a sudden this thing could bounce back up. You got some nice gaps to fill. And do you find yourself getting to 16 or $20? Yeah, it absolutely could. That was your PACW. What about Wall? WAL, Western Alliance Bank Corporation. Similar picture. And you know my feelings, Rob, on climactic volume, which you had today. It looks like the average volume for this thing's like 600,000. And today you traded 60 million shares of it. So a lot of people jumping on this. It may have been a combination of short covering as well. I mean, honestly, if you stayed short on this one today and you carried it overnight, I think you're kind of stupid. I really do. There's no way you can expect something to go from 75 down to an intraday low today on Western Alliance Bancorp of $7 and expect it to go to zero. They're not going to go to zero. I mean, it could, but the odds are fairly slim. This isn't something that basically is going to annihilate all the banks. You got a couple banks got caught up in it. I think you're fine. And then last one you had on there was, that First Republic, yeah. Again, I think every one of these bank stocks, I'm just going to click through here on some of them, have climactic volume. I mean, even like Charles Schwab today, as U.S. Bancorp, right? They're all looking that same basic picture of just big climactic volume. So that's kind of what leads me to believe we're going to bounce, which is, further supporting my decision to sell some puts, collect some premium. I guess you thought about buying outright, buying calls on them, because the calls were pretty cheap because of where price was at. But I just did the put thing, be a little bit safer that way. And if I end up owning it on Friday, I'm great. Mad Cat Pat says, I bought FRC, JP Morgan's, give them liquidity, so I think it's going to take time, give them 2 weeks. Yeah. I mean, and again, you just have to understand your risk, right? You want the 5-minute, Rob? Sure. There's that's your daily. So I don't really see much. I mean, this isn't really that attractive. Oh, that's US Bancorp. Sorry, let's go back to the ones you wanted. What was you had? I forgot the ticker symbol off the top of my head. It wasn't Pan W. It was PAC W. PACW. I don't see. I mean, there wasn't like a climactic necessarily right where it bottomed out, but the trend that happened here looks fine for me. Like I would feel okay buying into this one, but again, I wouldn't do it with all my capital. I would spread those things around so I don't get don't get caught off guard holding too much of one thing. Here's your wall. Similar, but I don't see the 5-minute really changing my perspective on the climactic volume bottoming out. Same here. You don't see one big surge. It actually just had high volume pretty much all day on this 5-minute time frame. All right. Yeah, pretty much sideways. Cool. That's going to wrap it up for me. So based off all this information, I had Bill Addis reach out to me today, and I was like, ooh, I love having Bill Addis on the program. And he says, hey, want me to come on your show? I'm like, oh, let's do it. So tomorrow we're going to have Bill Addis on the program. So we'll talk about bond markets, long-term yields, et cetera. We'll see what's going on with the yield curve. We'll see what the recent actions on the part of the Fed has done to bonds, et cetera. So if you guys have any questions for Bill Addis or myself, let me know. You can email me at TraderMerlin@gmail.com, which is on the screen, or go to YouTube videos, put your comments down below any YouTube video. I apologize, I didn't get a chance to look at them today because I've been really, really busy, but I will do my best to get all your questions answered on tomorrow's show, and really, I guess I have to go back and look through all of the comments because I just didn't get a chance to do it. You want to know about Credit Suisse? One last one, and then we are out skis. So I don't know Credit Suisse's business model. But, you look at the price chart. What I can tell you about Credit Suisse is these guys were in trouble long before Silicon Valley Bank. I mean, this thing has been trending down since February of 2021. It's been over 2 years of just nothing but down. So I look at this one, and I'd have to say I wouldn't touch it. Even at $2.50, I'm not touching it. I don't know. There's clearly something rotten here with them. So I wouldn't buy it personally, but again, I'm not a financial advisor. You guys got to make your trades and take the risk according to your risk profile and make sure you have your stops in place so you don't get smoked. All right. Thank you very much. Yeah, John, that's right. Hit that like button. Hit the subscribe button if you're new. I got a lot of new faces out there, so I hope you guys enjoyed the show. I hope you learned something. I hope it's going to be a good day for you all tomorrow. I will see you on this show with Bill Addis at 2 p.m. Pacific time. Take care, everyone. Have a great night. I'll see you tomorrow.